Hello and welcome to today's video in the series of microfinance and assessment skills. So today we're going to be looking at equity and fairness issues. Broadly, there are the following groups. Firstly, lenders who lend as any other financier would, but with the aim of helping the borrower. Secondly, lenders whose focus is on the community rather than the individual or family borrowers. In their lending form, they will have a question about how the proposal helps the community. And there are pluses and minuses in this approach. As a plus, it helps improve the community as a whole and not just a few people. And so you could say it is fairer and has wider benefits. On the other hand, this is a condition that borrowers in developed countries don't have to meet. Thirdly, some see microfinance as a stepping stone towards the creation of homegrown full-service banks. So they foresee a transition from lending funded by donors to eventually becoming deposit takers themselves with an obligation to repay deposits. And fourthly, some have a social agenda. They want to improve the status of women or a disadvantaged group. The above groups are very wide generalizations, but the result is that they have different lending rules and different target borrowers. It's not part of this course to evaluate the pros and cons of these different agendas in full, but it is important that you understand what viewpoint the lender you are approaching is coming from. Some would automatically turn down a proposal for one farmer to buy extra seed because it doesn't help the community. If there is more than one lender available, you should be able to pick which one your proposal fits best with. You also need to be sure that there is no conflict between the lender's values and your own. If the lender supports positive discrimination to correct long-standing imbalances, and you do not personally agree with this, there could be difficulties. If the lender has a wider agenda to change society, you need to think about whose agenda for change should it be. Should it be the developed countries, or the national governments, or the communities, or the micro-lenders, or yours? Now a little bit about size issues. Most microfinance lenders have a size limit on how much they will lend to any individual borrower. The thinking behind this is that their purpose is to provide small loans. Also, if they double the average size of the loan they provide, it will only be able to help half as many borrowers. However, the impact of this is that if a business is able to grow because of the microfinance loans, there will come a time when it is too big and can't get a loan anymore. In theory, by that stage, they will be big enough to get a loan from a normal bank. But it doesn't always work that way. Sometimes there is no bank in their location, or sometimes they are still too small for the normal bank to be interested in them. They get trapped in the middle, where they are too big for the microlender and too small for the normal bank. The result is they can't borrow, and their growth slows right down. Many people see this as an equity issue. They say it's not fair for the microlender to do this to a business, which has been a big success story for the microlender. Companies like this are excellent examples of the benefits that can come from microlending. When they get to this size, they are probably providing jobs for other members of the community. And then the lenders cut them loose and stop them growing at a strong rate. Maybe the answer is to have some new kind of lender who specializes in this kind of company. Their needs by this stage are a lot different from the very small micro borrowers. The problem is that there are not very many of the companies in the gap, so it's hard for a lender to have a successful business looking after only them. You should make up your own mind about who is right or wrong. But clearly there is a gap, and it's not good for the individual companies and the workers, or for the economy of the country as a whole. The country needs to have strong, growing companies to improve its situation and provide jobs. On the other hand, if they provide bigger loans to these bigger companies, that might mean they don't have money to make 3 or 4 loans to smaller companies. And this is the end, my friend. See you next time.